Economic policy often resembles walking a tightrope. Lean too far in one direction and stability collapses. Lean too far in the other and progress slows. The tension between inflation control and economic growth represents one of the most enduring dilemmas in macroeconomic management. Inflation targeting refers to a monetary policy framework in which the central bank commits to maintaining inflation around a specified numerical target. The objective is to anchor inflation expectations, maintain purchasing power, and ensure macroeconomic stability. In contrast, growth oriented policy prioritizes expansion in output, employment, and investment, often through accommodative monetary conditions such as lower interest rates and greater liquidity. The theoretical roots of this dilemma lie in the short run trade off suggested by Phillips' curve, which posits an inverse relationship between inflation and unemployment. Expansionary monetary policy can stimulate demand, increase investment, and reduce unemployment in the short term. However, excessive stimulus may also trigger rising prices, eroding real incomes, and destabilizing the economy. Countries adopting formal inflation targeting frameworks typically assign the central bank the task of maintaining price stability while allowing growth to emerge through stable macroeconomic conditions. In India, monetary policy operates within a flexible inflation targeting regime under which the central bank seeks to maintain inflation around 4% with a tolerance band. This framework recognizes that persistent inflation can undermine growth itself by distorting investment decisions, eroding savings, and disproportionately affecting poorer households. Yet, strict inflation targeting can sometimes constrain growth. When inflation rises due to supply side shocks such as food price spikes, energy disruptions, or global commodity volatility, rising interest rates may suppress demand without resolving the underlying supply constraints. Higher borrowing costs can dampen private investment, reduce credit flow to productive sectors, and slow economic recovery. This challenge becomes particularly acute in developing economies where structural bottlenecks, infrastructure gaps, and informal employment dominate the growth landscape. On the other hand, prioritizing growth without adequate regard for inflation risks macroeconomic instability. Persistently high inflation reduces purchasing power, increases income inequality, and erodes confidence in the currency. History shows that economies experiencing uncontrolled inflation often face capital flight, fiscal stress, and declining real wages. The policy challenge, therefore, lies not in choosing one objective over the other, but in calibrating a balanced approach. Flexible inflation targeting attempts to reconcile this tension by allowing temporary deviations from the inflation target when growth conditions require supportive policy. Monetary authorities increasingly rely on forward guidance, macroprudential measures, and coordinated fiscal policy to address supply constraints while maintaining price stability. Fiscal policy also plays a crucial role in easing this dilemma. Public investment in infrastructure, supply chains, agricultural productivity, and energy resilience can reduce structural inflationary pressures, enabling growth without triggering price instability. In addition, targeted welfare programs can protect vulnerable households during inflationary episodes without distorting macroeconomic stability. Ultimately, inflation control and economic growth are not adversaries but interdependent objectives. Sustainable growth requires price stability, and durable price stability often emerges from a productive and expanding economy. The real art of policy making lies in balancing these forces, like steering the economy through shocks while preserving both stability and opportunity.